In this video, I will explain how we trade supply and demand. It is similar to support and resistance, but we draw zones as rectangles instead of levels and trade from zone to zone with a set of rules that are different than support and resistance rules. Supply and demand enables accurate entries and exits, which makes it a superior method for trading in combination with price action and logic. We have 4 types of supply and demand zones that we can categorize into 2 types. The first type is continuation, and we have a rally base rally zone. We draw the zone from the last bearish candle's body before the move that led to a higher high to the recent low, which is close to this candle. On a drop-based drop supply zone, it is the same, just the opposite. We draw the zone from the last bullish candle's body before the move that led to a lower low to the recent wick, which is close to this last up candle. The second type is the reversal. Here we have a rally, base, and drop. The highest or most recent bullish candle's body to the recent high, which is close to it. It could be here, but in this case, this wick is higher, so we draw the zone like this. And the same for the demand zone. Drop, base, rally, most recent bearish candle's body, which is this one, to the recent low, which is close to it, and that is here in this case. Supply and demand zones form because of traders placing new trades or traders taking profits from trades. When traders place new trades and cause a zone to form, they will logically defend the zone in case the price returns to it. They do that by placing additional trades into the direction they placed their initial trades. We qualify these zones as stronger than profit-taking zones because placing new trades means that they want the price to reverse or move into the direction of their trades. When zones form because of traders take profits from trades, we don't expect a reversal when price returns to those zones, simply because they still might have positions and want the price to move further, and even if not, they have no reason to defend profit-taking zones, unlike zones where new trades were placed. We use zones only one or two times, because we expect those who place new trades while forming the zone to add to their positions when price returns to their entry. Okay, this is where the trades have been placed, the new trades. This is why the price goes up, and these orders have been consumed, and when the price returns, we expect them to place additional trades to make the price move into the direction of their new trades. But we don't expect them to do that more than 1 or 2 times. After they place their initial trade, they will do that 1 or maybe 2 times. That's why we long this zone when price returns for the first time. Don't long if price returns again, because the chance for a reversal decreases after the first reaction. Trade fresh zones. We trade zones that have been formed recently and not too long ago. Old zones have less chances to cause a reaction. Okay, again, the same example, drop, base, rally, and when the price returns here, long this zone if price returns shortly after it had formed. Don't long this zone when the price returns after too long, like after, depending on the time frame. We have certain time frames, and the time frames are for 1 minute up to 3 minute zones. We use them for 1 day. 5 minute up to 50 minute zones we use for 3 or 4 days. H1, H2, H4 zones are good for up to 1 month. Okay, 20 days up to 1 month. And 1 day zones, the daily zones, we use for 1 up to 2 months. These are not strict numbers, so it can be 1 day more or less, but these are numbers to keep in mind so that you don't trade too old zones because they are history already. Let's look at some real examples. Here we have a demand zone, and we start with the rally base rally. As you see, the rally base And then the rally that led to a higher high, here this is the high, and then here the price makes a higher high, so we take the zone from the last candle's body, which is this one here, to the recent low, which is close to it, and price shows nice reaction, as you see. Another example for a rally, base rally zone. So you see a rally, then a base, last bearish candle's body before the move that led to a higher high. So this was the high here, and you see the higher high. This is the base. Price returns and shows reaction, as you see. Now we look at the demand zone, which forms after a drop. Okay, a drop base rally zone. You draw the zone from the lowest bearish candle's body to the most recent low close to it. We take the last down candle here and draw our zone, and later when the price comes back, you see the reaction. Yeah, now we look at the supply zones. Let's start with the drop base drop. Here this one is already a drop base drop, and then you have another one here, drop. You have a bullish candle, and then a drop which makes a lower low right here. Then you can draw a base here from this last bullish candle's body up to the high, which is close to it. Price returns and then keeps dropping. Now we look at a supply zone which comes after a rally based drop zone, and you draw the zone from the highest bullish candle's body to the most recent high close to it. The multi-candle zone basically means that you can combine multiple zones that are close to each other. So here you have a rally-based drop zone, guys, this one here. Shortly after that, because the price makes lower lows, you have another supply zone formed here with this candle, and then another one. So you have 1, 2, 3 supply zones formed shortly after each other. So you can do to make it easier, you can draw them as one zone.